In 1985, the Plaza Accord changed everything for the dollar in just one weekend. 5 finance ministers met at a New York hotel and agreed to deliberately weaken the world's reserve currency. Within 2 years, the dollar lost nearly 50% of its value against major currencies. My grandfather lost 30% of his retirement savings purchasing power in that window. Not because he made bad investments, but because the currency itself was being restructured. Here's what most people don't know. We're seeing similar coordinated moves happening right now, just under different names, and the implications for your savings, your purchasing power, and your financial future are massive. If you want to understand what these shifts really mean and how to recognize the warning signs before they become headlines, you're in the right place. Let's dive in. The dollar's dominance isn't guaranteed by some law of nature. It's maintained by specific conditions, and when those conditions erode, things can change faster than most people realize. Since 1944, the US dollar has been the world's primary reserve currency, the currency central banks hold, the currency oil is priced in, the currency that facilitates most international trade. But that status comes with requirements, and right now, several of those requirements are showing cracks. I'm going to walk you through 5 hidden signals that suggest the dollar's position is more fragile than the evening news would have you believe. These aren't conspiracy theories or doomsday predictions. These are documented patterns that have preceded every major reserve currency transition in history. And I'll show you exactly how these abstract economic shifts translate into real consequences for real people. Quick note, this video is for educational purposes only and does not constitute financial advice. Always do your own research and consult with qualified professionals. Let's start with something that happened just last year that barely made the news. In 2024, central banks around the world purchased over 1,000 tons of gold for the 3rd consecutive year. According to World Gold Council data, this represents the strongest period of central bank gold buying since 1950. But here's what makes it different this time. It's not Western central banks doing the buying. It's emerging market central banks. China, India, Turkey, Poland, Singapore. They're systematically diversifying away from dollar-denominated assets. Think about what that means. These aren't retail investors or hedge funds. These are the treasurers of entire nations making strategic decisions about what holds value long term. When Poland's central bank increases its gold reserves by 150% in 2 years, that's not market speculation. That's a vote of no confidence. Now, you might be thinking this is just prudent diversification, and you'd be partially right. But let's look at the pattern. In the 1960s, before the collapse of the Bretton Woods system, foreign central banks started doing the exact same thing. France famously demanded physical gold for its dollar reserves. By 1971, the pressure became unsustainable, and President Nixon ended dollar-gold convertibility entirely. Here's what that looked like on the ground. Sarah Mitchell, a school teacher in Ohio, watched her savings account lose 1/3 of its purchasing power between 1971 and 1974. She'd been saving for a house, $15,000 tucked away carefully over 6 years. That amount could have bought a nice 3-bedroom home in 1971. By 1974, it barely covered a down payment. She didn't lose money in the stock market. She didn't make risky investments. The value of the currency itself had shifted beneath her feet. The parallel isn't perfect, but the psychology is identical. When the world's central bankers start hedging against the reserve currency, it signals something deeper than economics textbooks can capture. It signals trust erosion. Here's the second signal, and it's happening in slow motion, which makes it easy to miss. The dollar's share of global foreign exchange reserves has declined from 73% in 2001 to approximately 58% in 2024, according to IMF data. Now, I know that might not sound dramatic. It's still the majority, right? But consider the trajectory. In the past 4 years alone, the dollar lost nearly 5 percentage points of market share. That's the fastest decline since the euro's introduction. What's replacing it? A mix of currencies, the euro, the Chinese yuan, even smaller currencies like the Australian dollar. But here's where it gets really interesting. Several countries are now holding reserves in cryptocurrencies and conducting bilateral trade agreements that bypass the dollar entirely. Saudi Arabia and China completed their first yuan-denominated oil transaction in 2022. Brazil and Argentina are discussing a common currency. India and Russia are settling trade in rupees and rubles. These aren't isolated experiments. They're coordinated moves to create alternatives to the dollar-based system, and they're accelerating. Let me put this in perspective with an analogy. Imagine you run a neighborhood where everyone uses your homemade currency because you're the most reliable, most trusted person around. Then, gradually, your neighbors start creating their own currencies and trading with each other directly. At first, they still use yours for major transactions, but over time, they need it less and less. Eventually, your currency is just one option among many, and you lose the special privileges that came with being the standard everyone used. That's what's happening to the dollar's reserve status. The transition is gradual, which makes it feel less urgent, but historically, these transitions accelerate suddenly once a tipping point is reached. And when they do, ordinary people feel it first. Now, this is where it gets even more concerning. The third signal involves something called the petrodollar system. Since the 1970s, oil has been priced primarily in US dollars. This created automatic demand for dollars worldwide. If you wanted to buy oil, you needed dollars first. This petrodollar arrangement has been one of the key pillars supporting dollar dominance for 50 years. It meant the US could run larger trade deficits because the world needed dollars for energy transactions. But that system is quietly unwinding. In June 2024, Saudi Arabia chose not to renew its 50-year petrodollar agreement with the United States. Now, Saudi Arabia is open to settling oil sales in multiple currencies, including the yuan, euro, and even digital currencies. The UAE, Kuwait, and other Gulf states are having similar discussions. According to Reuters analysis, approximately 20% of global oil transactions in 2024 were settled in currencies other than the dollar, up from just 5% in 2019. That's a 300% increase in 5 years. The trend is unmistakable. Why does this matter to you? Because when global dollar demand decreases, the relative value of every dollar you hold decreases too. It's basic supply and demand. If the world needs fewer dollars to conduct business, those dollars become less valuable. That shows up as inflation in your grocery bill, your gas tank, your rent. Let me show you exactly what I mean. When the British pound lost its reserve currency status after World War II, British citizens experienced what economists call imported inflation. James Whitmore, a factory worker in Manchester, kept a detailed diary during the 1950s and 60s. He noted that his weekly grocery budget doubled in less than a decade, not because Britain had runaway money printing, but because the pound could buy less on international markets. British people needed more pounds to buy the same amount of imported goods. Coffee became a luxury, so did bananas. The purchasing power of everything he'd saved for retirement eroded steadily, year after year. That's the hidden cost of reserve currency transition. It doesn't announce itself with headlines. It shows up in smaller, incremental ways that compound over time. Here's the fourth signal, and it's one that most financial analysts are watching very carefully. U.S. government debt now exceeds $36 trillion. According to the Congressional Budget Office, interest payments on that debt are projected to exceed $1 trillion annually starting in 2025. Let that sink in. The U.S. government will spend more on interest payments than on national defense, more on servicing old debt than on building new infrastructure, funding education, or maintaining social programs. Now, high debt alone doesn't doom a currency. Japan's debt to GDP ratio is higher than America's, and the yen remains functional. But here's the critical difference. Japan owes most of its debt to Japanese citizens and institutions. The U.S. owes roughly 30% of its debt to foreign creditors, primarily China, Japan, and oil-exporting nations. And those creditors are becoming more selective. China has reduced its U.S. Treasury holdings from a peak of $1.3 trillion in 2013 to approximately $770 billion in 2024, according to U.S. Treasury data. Japan's holdings have also declined. They're not dumping treasuries in a panic. That would hurt them too, but they're gradually reducing exposure. Think of it like this. If you're a country lending money to the U.S., you want to be confident you'll be repaid in dollars that hold their value. But if you see the U.S. printing money to service debt, running persistent deficits, and facing political gridlock on fiscal policy, your confidence erodes. You start looking for alternatives. History shows this pattern clearly. The British pound was the world's reserve currency for over a century, but after World War II, Britain's debt burden became unsustainable. Foreign holders of pounds began diversifying. By 1956, during the Suez Crisis, Britain realized it no longer had the economic leverage it once did. The pound's reserve status ended not with a bang, but with a gradual recognition that the fundamentals had changed. And British retirees paid the price. Margaret Thompson had worked as a nurse for 35 years, diligently saving pounds. When she retired in 1965, her pension could afford a comfortable life. By 1975, that same pension barely covered basics. The pound had lost over 60% of its international purchasing power in a decade. She'd done everything right, worked hard, saved consistently, lived within her means. But the currency transition happened anyway. But wait, there's something even more important than debt levels themselves. The fifth signal is about monetary policy credibility, and it's the most subtle but potentially the most significant. The Federal Reserve expanded its balance sheet from under $1 trillion before 2008 to over $8 trillion by 2022. That's an 8x increase in the monetary base in less than 15 years. While the Fed has since reduced its balance sheet somewhat, the precedent has been set. When crisis hits, the U.S. response is massive monetary expansion. Now, I'm not here to debate whether quantitative easing was necessary. That is a legitimate economic discussion with smart people on both sides. But I am here to point out what that signals to international observers. It demonstrates that when faced with choosing between short-term economic pain and long-term currency stability, U.S. policymakers choose short-term relief every single time. According to research from the Bank for International Settlements, trust in a reserve currency depends heavily on perceived policy discipline. When a central bank shows willingness to dramatically expand the money supply, it raises questions about future inflation and currency depreciation. You might be thinking, okay, but hasn't the dollar remained relatively strong despite all this? And you're absolutely right to ask. The dollar index has actually performed well in recent years, particularly during global uncertainty. But here's what most people miss, that strength is largely relative. The dollar looks strong compared to the euro during Europe's energy crisis, compared to the yen during Japanese monetary policy shifts, compared to emerging market currencies facing their own challenges. But strength relative to other struggling currencies isn't the same as fundamental strength. It's more like being the best-looking house in a neighborhood that's declining. You're still losing value. It's just less obvious because your neighbors are losing value faster. Let me give you a real-world example of what this looks like. In 2021, Michael Chen, a software engineer in California, was earning $120,000 a year. By traditional metrics, he was doing well, top 10% of earners. But between 2021 and 2024, even as his salary increased to $135,000, his actual purchasing power declined. Housing costs jumped 30% in his area. His grocery bill increased 25%. Healthcare premiums up 18%. His dollar salary went up, but each dollar bought less. That's the hidden tax of monetary expansion. Your number goes up, but your actual economic position doesn't improve proportionally. Now, this is where everything connects. Let me show you the bigger picture. What we're witnessing isn't a dollar collapse, at least not yet. What we're seeing is the gradual erosion of the conditions that made the dollar uniquely dominant. Central banks diversifying into gold, reserve currency share declining, petrodollar system fragmenting, major creditors reducing exposure, monetary policy credibility questions. Individually, each signal could be dismissed. Collectively, they form a pattern that history tells us matters. And here's the thing about patterns in currency markets. They develop slowly, then resolve suddenly. The British pound's transition took decades of gradual decline, punctuated by sharp crisis moments. The same was true for the Dutch guilder before that, and the Spanish real before that. The pattern always looks the same. First, subtle shifts that only specialists notice. Then, accelerating changes that the financially informed start tracking. Finally, a catalyzing event, a crisis, a war, a policy mistake that crystallizes the new reality. And when that happens, it's the everyday person who feels it most acutely. So what does this mean for you? How should you think about this? First, understand that we're talking about probabilities and time frames that are measured in years or decades, not weeks or months. The dollar will almost certainly remain important in your lifetime. But its unique privilege, the ability to print the world's reserve currency with minimal immediate consequences, may be diminishing. That has implications for inflation, for interest rates, for the purchasing power of your savings, for what your retirement actually looks like. Second, recognize that diversification isn't just about stocks versus bonds. It's about understanding currency risk, when the value of the dollar itself is uncertain. Holding assets denominated only in dollars means you're concentrated in one currency bet, whether you realize it or not. You're essentially betting that these 5 signals don't accelerate. that the historical patterns don't repeat, that this time is different. Third, watch the signals. Pay attention when central banks make moves. Notice when trade agreements start bypassing dollar systems. Track reserve currency composition data from the IMF. These aren't random fluctuations, they're indications of larger shifts. The people who recognized these patterns with the British pound in the 1950s or the Dutch guilder in the 1700s had time to adjust. The people who dismissed them didn't. Fourth, understand that this isn't about predicting a specific event on a specific date. It's about understanding structural changes that shift probabilities. You don't need to predict the exact moment a currency transitions to recognize that the conditions for such a transition are developing. Think of it like earthquake risk. You can't predict when the earthquake hits, but you can recognize when pressure is building along fault lines. Fifth, and this is crucial, think about what your financial life looks like in different scenarios. If inflation averages 2% annually, your retirement calculations work one way. If it averages 5% because of dollar weakness, they work very differently. $1 million sounds like a lot until you realize that at 5% inflation, it loses half its purchasing power in 14 years. These aren't abstract numbers. This is the difference between retiring comfortably at 65 or working until 72. If you're finding this valuable, hit that subscribe button. We uncover these hidden patterns every week, the kind of analysis that connects the dots between central bank decisions and your actual financial reality. No one can tell you exactly when or if the dollar will lose its reserve status completely. History suggests these transitions are complex, multi-decade processes influenced by geopolitics, economic fundamentals, technological change, and random events that no one can predict. But history also shows that dismissing warning signs because the timeline is uncertain is exactly how people get caught unprepared. I think about Sarah, the schoolteacher who saved diligently but saw her house dream evaporate. About James, the factory worker who watched his grocery budget double. About Margaret, the nurse whose pension became insufficient. About Michael, the engineer earning more but able to afford less. These weren't reckless people. They weren't financially illiterate. They simply lived through currency transitions and adjustments they didn't see coming. The signs are there. They're hidden in central bank balance sheets and international trade data, in subtle shifts in how nations interact economically. Most people won't notice until the changes are already reshaping their financial reality. But you're here, you're paying attention, and that puts you ahead of the curve. The question isn't whether to panic. It's whether to prepare. It's whether to understand the structural forces at play so you can make informed decisions about your own financial future. It's whether to recognize that in a world of shifting currency dynamics, knowledge itself becomes a form of wealth preservation. If this changed how you think about the dollar's future, you need to watch my video on what happens when reserve currencies collapse. Historical patterns you need to know. It takes these concepts even deeper into the actual mechanics of currency transitions and what they meant for ordinary families. And if you haven't subscribed yet, now's the time. We uncover these hidden financial patterns every week, the truths that don't make evening news headlines but affect your money nonetheless. See you in the next one.